Hello and welcome to the Tax Roundup for August. This month we're going to take you through a few of the details that have been released, consolidating those budget measures that were announced. We're also going to take a look at some tools from the ATO to help those looking to take advantage of the new employee share scheme arrangements. Then we're going to take a look at a couple of cases. The first one looking at the John Holland case and the outcome of that, which is a tax and travel case. And the second one looking at alienation of personal services income and why just because you're in a company structure won't protect you from the PSI rules. First off, across to Ray to look at those budget measures.
We now have two pieces of draft legislation which follow on from announcements in the budget. One is in relation to changes for car deductions, the other was in relation to the zone tax offset. Now, the zone tax offset was intended to compensate taxpayers who were living in very remote areas and would obviously face additional costs and expenses shipping things in. It's a lot more expensive to live there. But what the tax office found when they did a review is that up to 20% of the individuals who were claiming that tax offset were not the individuals who were actually living there full time. They were not living there for 183 days as required by the rules. They were people who were on fly-in, fly-out or drive-in, drive-out arrangements who, although they were physically spending time there, they weren't genuinely living there. So, due to the changes in the draft legislation, when those go through, effective from the 1st of July 2015, those individuals on fly-in, fly-out and drive-in, drive-out arrangements will no longer qualify for the zone tax offset. The second change is in relation to car deductions. Now, currently, we have 4 different methods by which an individual can claim deductions for the work-related use of the car. 2 of those, the 1/3 method and the 12% method, are used in less than 2% of the taxpayers. So not surprisingly, Treasury is going to clean things up, simplify them, and we will be left with 2 different methods for claiming a car deduction. The first one is the logbook method, which we already have, that will pretty much be retained as is, no major changes. The second one is the cents per kilometre method. Now, at the moment, we have 3 different rates for 3 different engine sizes. That will be simplified. It will be one standard rate of 60 cents per kilometre, regardless of the engine size. So hopefully that will make it a lot easier for taxpayers to claim the deduction and an awful lot simpler for the tax advisors to help them do so.
The new and more generous employee share scheme arrangements came into effect on 1 July 2015. For those looking to take advantage of those arrangements, the ATO has released a series of tools. Mike Corellas takes you through what's available.
Just a bit of an update around employee share scheme rules. We now have updated rules in play. Legislation went through Parliament, received royal assent. So from 1 July 2015, we do have a new set of employee share scheme rules that apply primarily to shares and options issued from 1 July 2015 onwards. So where we have clients who were issued with shares or options in prior years, we still need to really look at the old rules. So it's going to be a little bit tricky for a while as we get used to applying a couple of different sets of rules depending on the relevant date. But going along with that, following the release and the passing of those new rules, we've got some other things that have come out around the employee share scheme rules. Now, the first one is the ATO has released an employee share scheme calculator, which could be used either by employees or employers. I've had a bit of a play around with it. It's useful to some extent, and certainly at a very high level, it might just help work through some of the issues and trying to get your head around what the numbers might look like. But it probably is a little bit limited and needs other things done around it. Possibly of more interest though is when the new employee share scheme rules were passed, the Commissioner was given the power to basically come up with safe harbour methodologies for valuations. And interestingly, that's not restricted to just the employee share scheme rules. But as a starting point, the Commissioner has put forward and released a couple of safe harbour methodologies that can apply under the employee share scheme rules. Now, these can only be used when you're relying on or trying to use the small startup company concessions that are contained within the new rules. So only relevant for those plans issued from 1 July 15 onwards. But basically what this instrument does, it provides 2 different approaches that can be used to put a value on unlisted shares in small startup companies. And there's probably 2 reasons you might think of using those approaches. One is cost. Rather than going out and necessarily getting a valuation done for small startup companies that might be a bit cash strapped, you can potentially just work through this approach that's set out by the ATO and come up with a value. The second main one is the risk and the certainty factor. if you rely on the ATO approach and you follow the methodologies correctly and you fall within the relevant conditions, then the ATO will accept that valuation, even if it is different to what the number would have been produced had a full market valuation been done. So there's a couple of reasons why you might want to consider working through those approaches. At the moment, though, they are limited to that small startup concession under the new rules, but we might see the ATO over coming months and years even release more safe harbour approaches or methodologies that could be used in a wider range of situations. And it'll be just interesting to see where that ends up. Just coming back to the two approaches, just really high level. First one is basically you look at the financial statements for the company and you're basically taking the net tangible assets as a basis for doing the valuation. So pretty simplistic approach. It shouldn't involve a whole lot of work as long as the company has financial statements that are prepared in accordance with accounting standards, and that may not always be the case in the starting point. The other approach enables the CFO of the company or someone else with relevant experience to work through a number of factors and come up with a valuation, which then needs to be formally signed off by the directors of the company as representing market value. Now, working through that process, in some ways you may as well have just gone through a full valuation process anyway. So not sure exactly what the take up on that option will be. Certainly the first option will be a little bit more attractive to very small companies that are trying to do a quick and cheap, inexpensive and simple approach to doing that valuation. But as I say, we might see some more approaches being released and it'll be interesting to see what the Commissioner comes up with.
Our first case this month looks at alienation of personal services income and why you just can't assume what the likely outcome is.
Now we have a timely reminder for advisors that just because an entity is an entity does not mean that it gets out of the PSI provisions. So Prasad Business Centres is a case that went forward to the AAT because the taxpayer had applied to the Commissioner for a personal services business determination and the Commissioner refuted. So then it went to the AAT, who looked at all the facts and agreed with the Commissioner. This is not a personal services business. The taxpayer, Prasad Business Services, entered into 3 different contracts with its client to provide services to their client. Now the 3 different contracts nominated one key person, Mr. Prasad, the same person for all 3 services, the only person doing any of the work on behalf of the company. In each of the 3 cases, the taxpayer, being the company, provided the individual who would work at the client's premises. They were paid a certain rate per day, they would invoice every fortnight, and if that key person did not work on the day, the taxpayer, being the company, did not get paid for that day. And whilst the AT said we agree that the work that is being done by the individual is contributing towards a result that's being achieved, they're not being paid to achieve a result. They're being paid for the number of days that key person turned up on behalf of the taxpayer. So unfortunately, looking through the facts here, it is a bit of a wonder, why did they think that this one might get through? But once again, a time reminder that PSI is always a lot more complicated than people think.
Our final case this month is the John Holland tax and travel case. Mike Carruthers explains the case and what the implications are more broadly.
Well, this month it looks like we finally have a resolution to the John Holland case, which has been floating through the courts over the last few months. Now, this case dealt with an FBT issue, but it also has wider implications for the treatment of travel expenses. In a nutshell, what happened was we had John Holland, an employer that had employees working in locations that were not close to major capital cities. And what happened was the employees were responsible for getting their way to a particular airport, and that was the agreed departure point. John Holland was then responsible for transporting the employees to the actual place of work. And these were fly-in, fly-out work arrangements. Now, the issue was all around FBT. And when John Holland transported the employees from that agreed departure point out to the place of work, was it subject to FBT? What John Holland argued was that the otherwise deductible rule applied. So had the employees incurred those travel expenses personally, they would have been able to claim a deduction for it, so no FBT expense. Now, if the facts were slightly different and the place of work was in a remote location, there's actually a separate FBT exemption that would have applied. But because the work location wasn't technically in one of those remote locations, then it was the otherwise deductible rule that was at issue. So the real key issue for the courts was, would the employees have been able to claim a deduction for that travel had they been personally liable for those costs? Now, interestingly, we had the decisions going back and forth through the courts. Where it ended up was the full federal court, and the full federal court found for the employer. Full federal court agreed with John Holland that the employees would have been able to claim a deduction for those travel costs. Now, the general principle is normally that travel from your home to your normal place of work is not deductible. You're not doing the travel in the course of your income earning activities. It's a private type expense. In this case, things are a little bit different though. And probably two major things stood out. First one was, once the employees arrived at that agreed departure point, they started being paid. So from that point onwards, there was an argument they were deriving assessable income. So the travel they were doing was in the course of deriving assessable income. The other thing was, the employees were under the direction and control of the employer from that point onwards. So even though they hadn't fully arrived at their normal place of work, it was from that departure point onwards that they were considered to be basically on the clock and working for the employer. So those factors combined led the full federal court to decide that the employees would actually have been able to claim a personal deduction for those travel costs. As a result, the otherwise deductible rule could apply and there was no FBT liability for the employer. Now, presumably, the ATO would still take the view that the employee travelling from their home to that agreed departure point would still be a non-deductible expense. So important to recognise that this decision only goes part the way there, and it really does depend on the circumstances as to whether this decision would change the normal treatment for employees who are travelling to work or employers who are funding or providing transport for their employees. All in all though, an interesting decision because it does play around with some of probably the accepted beliefs and understandings around travel, whether that's paid by employers or employees. This week we found out that the ATO would not be appealing this decision to the High Court, so a full federal court decision stands and that is where things will stand. So interesting case, and it's good to finally have a resolution on it given that it was going back and forth a little bit over the last 6 months or so.
And that's the tax roundup for this month. Remember, if you haven't seen what Knowledge Shop has to offer, then give us a call on 1800 800 232. We have a whole knowledge base of updated standards for the 2015-2016 year. It's really something with a rate of change you should be looking at for your practice. So talk to Julie and she will show you what's on offer. See you next month.